In September of 2022, Japan spent $62 billion defending its yen. The Japanese yen was sitting at a painful 151 per dollar then. That intervention worked, but only temporarily, as financial history always shows. Now the yen has crashed right back to 159 per dollar today. Japan's Finance Minister Katayama just issued a very specific public warning. He stated clearly that officials retain a complete free hand to intervene. Those words were not chosen casually or for dramatic political effect. Japanese officials choose their words with extreme precision before any financial action. Decisive action is the specific phrase Japan uses right before intervening. That exact phrase just appeared publicly, and markets immediately took serious notice. If Finance Insight is adding real value, subscribe to the channel now. Hit the notification bell and never miss another important financial update again. Now back to the numbers, because what they reveal is genuinely alarming. Understanding why the yen hit 159 requires understanding Japan's entire rate story. The Bank of Japan raised its policy rate to 0.75% recently. That is the highest Japanese interest rate seen since the year 1995. 3 decades of near zero interest rates defined Japan's entire modern economic identity. Zero rates were Japan's primary tool to fight deflation and stimulate growth. Now Japan is finally moving away from that extreme zero rate policy. But even 0.75% cannot stop the yen from falling sharply now. The gap between US and Japanese rates remains the core driver here. America's Federal Reserve has kept rates significantly higher than Japan's rate currently. That wide interest rate gap pulls capital relentlessly out of yen investments. Investors borrow cheap yen and invest it in higher yielding dollar assets instead. This strategy is called the carry trade, enormous in financial scale. The yen carry trade is estimated at hundreds of billions of dollars. Every time Japan holds rates steady, the carry trade expands further. That constant expansion creates steady selling pressure on the yen every day. The result is a currency that keeps sliding despite every official warning. And that is exactly what the 159 per dollar reading reflects. But the interest rate gap alone does not explain the full crisis. Japan imports over 90% of all its energy from foreign sources. That dependency makes Japan uniquely vulnerable to currency and energy shocks. Right now, Japan is being hit by both of those shocks simultaneously. The Iran conflict has severely disrupted critical global energy supply routes. The Strait of Hormuz carries 20% of global oil supply. Disruptions at Hormuz mean immediate energy price increases across Japan entirely. Japan's core inflation just accelerated for the first time in 5 months. Rising energy costs are the primary driver of that fresh inflation acceleration. This is deeply uncomfortable news for the Bank of Japan's policy position. The Bank of Japan now faces a genuine dilemma with no exit. Raising rates faster might slow inflation, but risk tipping Japan into recession. Holding rates steady means the yen keeps falling and imports cost more. Both choices carry serious economic pain for ordinary Japanese households right now. The Bank of Japan meets next week under enormous competing policy pressures. It is expected to raise inflation forecasts while cutting growth projections. Raising inflation forecasts while cutting growth is textbook stagflation territory, dangerous territory. Japan, the world's third largest economy, is now genuinely flirting with stagflation. That combination makes the yen's position at 159 even more globally alarming. Understanding Japan's history with currency intervention explains why 159 matters so intensely. Japan has directly intervened in currency markets only a few times historically. The 1998 intervention came during the devastating Asian financial crisis market stress. The 2011 intervention followed Japan's devastating earthquake, tsunami, and nuclear disaster emergency. The 2022 intervention came when the yen first crossed 151 per dollar. Each intervention was preceded by the exact same official language used now. Free hand and decisive action are the phrases that precede actual intervention. Finance Minister Katayama used both precise phrases in one public statement. That is not coincidence. That is a carefully constructed and deliberate signal. When Japan speaks this clearly in public, intervention is measured in days. Markets are now pricing in an elevated probability of imminent intervention. The 160 level per dollar is Japan's ultimate psychological pain threshold. At 160 yen per dollar, import costs become unbearable for Japanese consumers. Food prices, energy bills, and manufacturing costs surge at that level. The yen sits at 159, 1 point from that critical threshold. That proximity to 160 explains exactly why official warnings are escalating dramatically. Japan's government cannot politically afford to let the yen cross 160 unchallenged. Public anger over the cost of living is Japan's top voter concern. Prime Minister Takaichi's strong approval ratings depend entirely on economic management performance. Allowing the yen to cross 160 would be catastrophic for Takaichi politically. This political dimension makes currency intervention almost certain if 160 is tested. Now consider what a Japanese currency intervention does to global financial markets. Japan's 2022 intervention moved the yen 5% in a single day. That single-day move sent immediate shockwaves through global bond and equity markets. U.S. Treasury yields spiked sharply as Japanese investors began repatriating capital home. Asian stock markets fell sharply within hours after that 2022 intervention. A 5% currency move in one day is extraordinarily market-moving. Most major currencies rarely move more than 1% in one day. Japan's $62 billion single-month operation remains almost unprecedented in market history. If the next intervention matches 2022, the global market impact is massive. Every investor in every asset class needs to understand this growing risk. The yen's weakness is not just a Japanese problem, it is global. Japan is the world's largest foreign holder of U.S. Treasury bonds. Japan holds approximately $1.1 trillion in U.S. Treasury securities in 2026. When Japan intervenes, it often sells U.S. Treasuries to raise necessary dollars. Selling U.S. Treasuries pushes U.S. bond yields immediately and significantly higher worldwide. Higher U.S. yields mean higher mortgage rates and borrowing costs for everyone. A Japanese intervention reaches directly into American household budgets very fast. This is why global markets are watching the 159 yen level carefully. It is not just Japan, it is the entire global financial system. And there is one more critical dimension to this story explaining everything. Japan's demographic crisis makes every one of these problems significantly harder. Japan has the oldest population of any major economy on the planet. More than 28% of Japan's population is age 65 or older. An aging population means fewer workers, lower productivity, and massive pension pressures. These structural pressures make Japan's monetary policy exit incredibly difficult to execute. The yen's weakness amplifies all of those structural pressures simultaneously and painfully. Imported inflation hits retirees hardest because they spend more on necessities. Japan's pensioners are squeezed by the very policies meant to help them. Every data point, yen, inflation, energy, demographics, pushes in the same direction. The intervention warning is not noise, it is Asia's loudest financial signal. The demographic pressure on Japan runs deeper than most analysts currently discuss. Japan's workforce has been shrinking steadily for over 2 full decades now. Fewer workers mean lower tax revenues and higher government deficit spending always. Japan's national debt stands at an extraordinary 260% of GDP today. No other major developed economy carries a debt burden anywhere near that. That debt mountain is the hidden structural engine behind the yen's weakness. Japan finances its enormous debt through aging domestic household savings pools primarily. As Japan's population ages further, that critical domestic savings pool keeps shrinking. Less domestic savings means Japan must attract increasingly expensive foreign capital inflows. Foreign investors always demand higher yields before committing serious capital into Japan. This creates an almost impossible situation for the Bank of Japan entirely. Raising rates too fast risks pushing Japan's fragile economy into deep recession. Keeping rates too low lets the yen keep sliding toward even more dangerous levels. No central bank anywhere currently faces precisely this combination of pressures simultaneously. That impossible policy trap is exactly why 159 per dollar is alarming. Japan's Prime Minister Takaichi won her historic election on a pro-growth platform. Her platform specifically includes suspending food consumption tax to ease household pain. Suspending food tax provides household relief, but adds more pressure to deficits. More deficit spending makes Japan's already enormous debt problem progressively worse overall. This tension between household relief and fiscal discipline is deeply and structurally unsustainable. Something inside Japan's financial architecture will eventually crack under these mounting pressures. The yen at 159 is the first visible crack appearing clearly in markets. Now zoom out and look at what this means for Japanese exporters specifically. A weaker yen sounds immediately beneficial for Japanese export companies on the surface. Toyota, Sony, and Honda all earn substantial revenues in foreign currencies abroad. When those foreign revenues convert back into yen, they appear larger temporarily. This is precisely why Japanese stocks initially rally when the yen weakens sharply. But that apparent benefit carries very serious and economically damaging structural limitations. Japan imports oil, gas, food commodities, and industrial materials from global markets entirely. Every 1% yen decline makes every single import measurably more expensive. At 159 per dollar, import costs have risen dramatically over just 2 years. Japanese manufacturers face higher input costs that directly erode profits from yen weakness. The net economic benefit to Japanese corporations from yen weakness is turning negative. Bank of Japan research confirms this deepening input cost squeeze is significantly worsening. Small and medium-sized Japanese businesses suffer most severely from this import cost pressure. These businesses simply cannot hedge currency risk the way giant multinationals efficiently do. They absorb every single yen decline directly into their operating costs and margins. Japan's small business sector employs the vast majority of Japan's total working population. When small businesses suffer, households immediately feel it through job losses and wage cuts. This painful transmission mechanism is what makes the 159 yen per dollar so dangerous. The political consequences of letting the yen cross 160 would be extremely severe. Japanese voter surveys consistently rank the cost of living as their top concern. Food prices in Japan have risen sharply because of sustained yen weakness entirely. Supermarket prices, utility bills, and daily fuel costs are visibly painful for families. Prime Minister Takaichi cannot politically survive allowing that household pain to deepen further. This political reality makes Finance Minister Katayama's intervention threat genuinely and immediately credible. When political survival aligns directly with financial intervention, action probability reaches its maximum. That is precisely the position Japan now occupies, sitting at 159 per dollar. The mechanics of how Japan would actually intervene deserve careful and detailed examination. Japan's Ministry of Finance holds direct legal authority to authorize currency intervention immediately. The Bank of Japan then acts as the operational agent executing any intervention. Japan's method involves selling US dollars and simultaneously buying yen directly in markets. This directly pushes yen demand higher and the dollar lower in currency markets. Japan holds approximately $1.1 trillion in U.S. Treasury securities available for this purpose. Selling treasuries converts dollars into yen, physically pushing the exchange rate higher. But selling U.S. Treasuries simultaneously increases bond supply in the global market. Increased Treasury supply pushes U.S. bond prices lower and yields immediately and sharply higher. Higher U.S. yields ripple through every single borrowing cost across the American economy. Japanese intervention, therefore, reaches directly into American mortgage and personal loan rates quickly. That direct connection explains why every global bond market watches the yen carefully. The 2022 intervention pattern showed exactly how rapidly these serious ripple effects spread. Within 48 hours of Japan's move, U.S. 10-year Treasury yields spiked noticeably. American mortgage rates ticked measurably higher within weeks of that single Japanese decision. The direct connection between Japan's currency and American household finances is unmistakably clear. Now consider the critical timing dimension, because in currency markets, timing is everything. The Bank of Japan meets next week under absolute maximum possible market scrutiny. The BOJ is widely expected to lift inflation forecasts while lowering growth projections. That specific combination of moves will further pressure the yen in the short term. If the yen slides toward 160 after the BOJ meeting announcement comes, intervention becomes not just likely, but virtually certain based on all available signals. Markets are now pricing elevated probability of imminent Japanese currency intervention very heavily. Massive short yen positioning means sudden intervention would force enormous and rapid position unwinds. Those forced unwinds could move the yen 5% in a single session. A sudden 5% yen move would immediately create significant volatility across global markets. Equity, bond, and commodity markets would all move sharply and violently in response. Investors with zero direct Japan exposure would still feel intervention's powerful market shock clearly. This is the hidden systemic risk embedded inside Japan's 159 per dollar reading. Understanding this precise risk is not optional for any serious global investor today. South Korea and Taiwan, deeply linked to Japan, would also face sharp ripple pressure. The Asian financial contagion risk from a sudden yen shock is historically well documented. So what practical steps should serious investors consider given Japan's escalating intervention warning? Currency diversification becomes critically important when major currencies face risk of violent adjustment. Gold has historically benefited whenever major currency interventions create sudden global market instability. World Gold Council data confirms gold consistently acts as a reliable currency volatility hedge. Portfolio diversification across multiple geographies reduces dangerous concentration risk during single-country financial events. Watching the yen closely around next week's Bank of Japan meeting is absolutely essential. Any move toward 160 could specifically trigger the decisive Japanese action now being warned. If intervention arrives suddenly, the defensive positioning window closes within minutes, not hours. Smart investors monitor currency moves the way meteorologists watch atmospheric pressure building relentlessly. When financial pressure builds this visibly and consistently, the storm is rarely far behind. Japan's yen at 159 is not simply an Asian currency story to comfortably dismiss. It reflects the deepest and most structural tensions inside today's entire global monetary system. Interest rate gaps, demographic pressures, energy dependency, and political survival all converge here. Every single historical precedent says official intervention follows this specific language within weeks. When Japan acts, every market on Earth responds, whether investors are prepared or not. The financially vigilant investor is already watching closely, positioned carefully and fully ready now. If Finance Insight is delivering real financial value, subscribe and hit the notification bell. Drop your biggest yen crisis question in the comments. The team reads everyone.